Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about precious metals, economics, and politics. Today is Tuesday, the 30th of July 2019, and we're having a discussion with Brother Anthony concerning a very simple method of earning additional income via property. Let's investigate. Welcome to Illuminati Silver's Inner Sanctum, where we are speaking with Brother Anthony, who we've not heard from for quite some time. Brother Anthony, welcome to our channel once again.
Thank you.
Now, it's been perhaps over a year or close to a year since we've spoken with you about some of your property exploits. Perhaps you could tell us what you've been up to over the last 12 months.
I've been racking up the air miles, if I'm to be quite honest with you. I've been to Kazakhstan, especially Almaty, 3 times over the last year, and I've been to Istanbul for a couple of occasions as well.
Anywhere else?
Well, around the UK, of course, London, Edinburgh. Haven't been over to Belfast for a while, but with Brexit coming along, there are opportunities that may present themselves in Belfast, especially if that's going to be a port of call for any international dealings that we're doing with the USA, as proposed by Donald Trump yesterday, I believe.
Oh, tell us more.
Well, as you're probably aware, Donald Trump has suggested a free trade deal between the US and UK should we have a successful Brexit and exit at the end of October this year.
So how would that, for example, benefit Belfast, which is a country you've just mentioned?
Okay, well, Northern Ireland is the nearest landmass to the US, so it makes sense that if we're trading via the Atlantic Ocean, that the ships stop in Ireland, Northern Ireland, obviously. And with that being a free trade zone, and next to the Republic of Ireland, which is part of the EU still, there may be options there for cross-border negotiations and trade deals.
But as you're aware, some of the criticism of the previous Prime Minister's deal was that the EU were insisting on a backstop. Now, most of us are aware of what that is, but to be candid, unless you're really involved in politics, you wouldn't. Could you just mention what that actually means when we mention a backstop and how that can affect trade potentially?
Well, the EU is proposing that there's a physical barrier so that checks can be made on cargo and goods coming into the EU. Now, it's ridiculous to suggest that there's going to be a physical wall or barrier, and well, we're not going to build one. The Republic of Ireland certainly couldn't afford to build one or man one. So we think that if Boris negotiates correctly, this will be left to technology. So by creating a free trade zone in Northern Ireland, which is a class of special economic zone. It's a geographical area where goods may be landed, stored, handled, manufactured or reconfigured and then re-exported under specific customs regulation. So there could be a lot of Amazon type warehousing and goods coming into Northern Ireland, ready to be stored before negotiating how they get through to the EU, ideally just by going over the border into the Republic of Ireland and then shipped normally.
But a lot of this, therefore, if I understand you correctly, is predicated on the UK doing a good deal, first of all with America post-Brexit, or potentially having a positive arrangement with the EU so that we don't actually have a hard Brexit. Am I right in that analysis?
Well, the terms are changing slightly. Republic of Ireland, whilst being quite bullish about the situation, seems to agree that there's no real need for a backstop. Leaving the EU at the end of October and doing a trade deal with America worth trillions of dollars would be a good start, and it would put pressure on the EU to come to the table and work out a deal, whether it's a hard Brexit and we go on World Trade Organization terms initially. That's yet to be seen, but the thought is that the Eurozone is in trouble at the moment. Financially, it's wobbling. Germany can't afford to keep it afloat on their own. They need the movement of goods to the UK. They need to sell their cars here. The French need to sell their wine here, their cheeses here. Otherwise, you're going to have car and wine and cheese mountains in Europe, which is no good to anybody, really.
So why is the EU then being so tough with the UK? How come Theresa May couldn't come to a deal? If it's not in the EU's interest to have a hard Brexit, why are they basically pushing the country into that corner?
Well, the country's divided. Obviously, it was such a close referendum result. They know that there's division in the country. They know pro-Brexiteers and Remainers are at odds at the moment, at loggerheads as to where to go next. And suddenly we've got things like a hard Brexit, a no-deal Brexit, when the only offer on the referendum was to leave Europe or not. The majority, over 17 million people, the most have ever voted in the UK for anything, said yes, we want to leave.
I think it was about 51.9% in favour, I think, if memory serves me correctly.
Well, it's quoted 52-48, but I'm not going to argue over
51.9. I'm pedantic, if nothing else.
So obviously what the EU doesn't want is for Britain to escape its clutches, set up free trade deals around the world, become a global leader for import and other development because of low tariffs and incentives, because what's to stop another EU country that's struggling to follow suit? Mm-hmm. There are certain countries in the EU that put more money in than they get out, Britain being one, Germany certainly being another, and you're going to have the people in those countries saying, hold on a minute, why are we subsidising the rest of the Eurozone when the Eurozone isn't moving forward? You know, the results this year economically have been poor. You could say that the Eurozone is in recession and there's a lot of pressure on the euro. Luckily, Britain's not in the single currency. Otherwise, it'd been a lot more difficult for us to circumnavigate our way out of the EU establishment.
Well, it's interesting you say that. You're absolutely right. We did not sign up to the single currency, the euro. However, as I've certainly produced a number of videos now on sterling sinking, and actually produced one today, which is published on the general YouTube, and not just for Inner Sanctum members like this one. And of course, we've seen sterling fall really ever since the original referendum. It recovered a little, but it started to fall back again. The result is, of course, gold and silver prices are virtually, certainly gold, is virtually at an all-time record high in sterling terms. We're literally just £5 off. So sterling has been falling. We believe it's going to continue to fall until the decision over whether we're going to have a hard Brexit or not is more certain. But meanwhile, that we have the governor of the Bank of England saying if you have a hard Brexit, it will be catastrophic for the United Kingdom. Now, controversially, Greg and Journo Marcus will argue vociferously that although maybe short-term, there may be some negative impacts, but longer term it'll be better for the country. And I personally also hold that view. But that said, how is it affecting, in your view, the property market, for example, which is an area you specialise in?
Well, the London property market has struggled recently. Geographically around the country, property's done quite well. It's gone up by 3% this year. It could still go up by the end of the year by another 2%. I'm expecting it to be around about 5% year-on increase. So there are pockets of areas. Britain doesn't have enough housing. Simple as that. We've got more people than we have houses. The government for many years hasn't been building enough houses year on year, which has put more pressure on social housing. So investors, builders, large corporations have been building swathes of new homes. and that's kept it up, supply and demand. There's a demand for housing, but that outstrips the supply. So I can't see a catastrophic effect. Yes, a run on sterling could put us in trouble, but at the moment, obviously it's encouraging manufacture because people can buy our goods cheaper because the pound is weak. People will spend more money coming here on holiday because the pound is weak. Just out of interest. Now, Britain's a bit of a strange character. When somebody goes on holiday, you judge how good somebody's holiday is by how much they paid for a pint of beer. So I could say I've come back from Kazakhstan, I've been to Almaty, and instead of being asked what were the mountains like, was it cold, is it strange being in an ex-Soviet country, people say, how much did you pay for a beer in Almaty? And when I say 80 pence, they say, oh, that sounds like a good place to go.
And what is it in the UK? £3?
In London, you're probably looking at £4 to £5.
Yes.
But if you go to Dublin,
yes,
which obviously is the capital of the Republic of Ireland and in the EU, you're paying £10 a pint.
£10 a pint? Seriously?
So it's all relative. At the end of the day, what you pay for a loaf of bread is the same whether your currency goes up or down. 56 pence for a loaf of bread will be 56 pence for a loaf of bread, even if the pound goes down against the dollar. Because the bread is made here and they don't change the prices. It's only imported goods that you may see a price increase. We were talking about Parmesan cheese, myself and a friend, yesterday. And he was suggesting that these big Italian restaurants who use a lot of Parmesan cheese might have to put their prices up. But when I pointed out that per serving of Parmesan cheese on somebody's meal probably costs about 8 pence,
yes,
for them to put an extra 10 pence on a meal doesn't really matter. It's not going to have a huge economic effect on the day-to-day lives of the people of the UK.
So, just edging back to property then, are you basically saying that people thinking about property investment in the United Kingdom actually should seriously consider it at this moment, in view of the fact that, yes, short-term a hard Brexit may have a slight impact on prices, but nowhere near the level that people fear, and if the supply stock is so low compared to demand, then price can only ultimately go one way, economics 101.
Indeed, unless the government really pull the finger out and start building tens of thousands of houses a year, which they don't want to do, because obviously they don't want to be spending the money. They'd rather private investors spend the money rather than themselves. It's hard enough getting money out of the government for transport links without building houses. I think what I specialise with my clients is cheap housing anyway.
Right.
There are areas, as you know, in locations where you can still buy a 3-bedroom house in the UK for in the region of £40,000.
Which is about $50,000, roughly.
Probably just under now with sterling slipping.
Yeah.
Now, those properties might need £10,000 spent on them. But you're going to get a rental income of £500 a month every month because of the shortage of housing. You can get social housing where the government actually pay you the rent. So you're guaranteed the money. Private housing, people are working but they can't afford the houses because of the supply and demand factor, but they want to live in certain areas. So there are opportunities. Now, worst case scenario, you've bought a house for £40,000.
Yes.
You've spent £10,000 on renovating it, on making it look nice, a nice kitchen, new bathroom, a touch of paint, just to freshen it. So your investment is £50,000. You're getting 10% return on that. And on rent.
Whereas in the bank you might get
normally good. If you're willing to put the investment in, you make money on the capital appreciation and it covers the rent as well. So a mixture of both, but it's a bit easier off the shelf. It's a bit easier to buy a house that's already been built, that needs a bit of TLC. You've got the same formula, you just go in, the same new kitchen in all of them, the same new bathroom in all of them, the same carpets in all of them, so that you set a standard, you know how much it's going to cost you, and then there's no ugly surprises.
So if someone is perhaps new to this area, and they're thinking, well, I've just been made redundant, I have £50,000, £100,000 payoff, or $50,000, $100,000 payoff, would you say that property is perhaps a good area to move into?
Certainly if you want a monthly income from it.
Right.
Because where else are you going to get a monthly income at 10% of what you've invested?
Yes.
Now, it would be easier for UK investors because UK investors can remortgage or refinance as well.
Explain that. Explain how that works.
Okay. We'll go again with the same example that I told you. So you're purchasing a property for £40,000.
Yes.
Yeah, putting £10,000 in for renovation and repairs.
Yes.
So you're into 50,000.
So you've spent, let's suppose your redundancy is 50,000. You have now spent all of your redundancy money.
Correct.
Right.
Now, that property is now valuing up at 70,000 because of the work you've done.
Yes.
And mortgage companies in the UK are quite happy to lend you 20%. You need a 20% deposit, so 80% of the value of the property.
Right. So they will lend you back then essentially £56,000 if my maths is right.
And what have you put in?
And you've put in 50.
So you could say the £6,000 covers costs, solicitors' costs, or any costs that you didn't envisage. So really, it's wiping its face.
But then, what sort of monthly payment are you then making for that borrowing, and what interest are you charged?
Well, say there's an interest rate of 3%.
Yes.
I'll let you do the calculation on £50,000, but it's not a
Yes.
lot of money. I'd say off the top of my head, it's about £111 a month,
Right.
give or take.
Yes.
Insurance on top of that, maybe £25 landlord insurance. So management fees of £40. Call it £200.
And that would be over and
That's
above.
over and above.
But then you're getting £500
Correct.
back on your money. So you're actually £300 up
Yeah.
per month,
Yes.
and you've still got 50,000 to invest in another property.
Correct. You normally have to hold on to the property for 6 months before you refinance it
That's in the UK.
in the UK.
Yeah.
So again, in 6 months' time, you can just repeat the process. If you get to 10 of those, well, you've got £3,000 a month coming in, and you've had your money back.
Right.
Obviously, it'll take you a little while to get to 10 if you're only
Yes.
investing 50,000 twice a year. However, if you've got more to invest, once you're happy with the model and you can see it working, then you can get more bullish with how much money you're investing. But start with one if you can afford it. As we say, spread your risk so you're not just investing in property.
Yeah.
The UK is a very safe country. There are places. I've got property in Turkey,
Yes.
which I inherited,
Yes.
where there's more uncertainty. You don't know whether the Turkish Prime Minister is going to turn around and say, right, no foreigners are allowed to live in Turkey anymore. We're taking your properties back.
Right. Fair enough. Fair enough.
There were problems in Spain where people had their houses taken back off them because of changes to the laws in Spain with property building, and they hadn't had the required certificates. So there's always a risk, but the UK is always seen as a safer haven.
Right.
Especially in times of uncertainty, money comes to the UK. Now, it's a bit funny saying when we're looking at what's happened to the sterling,
Yes.
but once we know where we are with Brexit, it's expected in the fourth quarter that investment in the UK will surge again. So let's see what happens, but the UK has always been a safe haven for money.
Now, most of our listeners, though, come from the United States and various states within the United States. So obviously they'll have their differing regional situations. Some states have still rising property prices. Other states have falling property prices. But is this generally a sort of model, broadly speaking, that can be replicated there?
I would have thought so. The problem with the United States compared to Britain is the United States has a lot of second and third homes,
Yes.
holiday homes.
Right.
Whereas in the UK, some people have holiday homes, but it's not the norm.
Right.
So where our supply doesn't meet the demand,
Yes.
in America there's more supply than the demand per se.
Right.
So this is my opinion. Obviously, I'm not an expert in the American market, but I have looked into it,
Yes.
and I have friends from the UK who've gone out there working in real estate. But my feeling for myself is if you just want a low-risk investment, that the UK is a safer place to actually look at putting your money. Now, I've got clients from South Africa whose properties I look after. I've got a client from Malaysia whose properties I look after. Now, there are tax implications, so you would have to pay tax, but you're still getting an incredible amount of return after having your money back. So your investment is zero. After
Yes.
6 months, your investment is zero and you're getting £300. So it's not as if it's like a 3,000% return. It's infinite because you've not got anything in it.
And from a portfolio management point of view, the advantage is you don't need to put all your eggs in one basket, but you can have properties all around the country. So as in America, you have regional differences, you do in the United Kingdom. So you could, for example, have a couple of properties in some of the counties of England, some of the areas in Scotland, some of the areas in Wales, and of course Northern Ireland if that floats your boat and it's convenient for you. But what are the downsides for doing something like this? Because I recall 15 years ago, there were people with not only tens of properties, but hundreds, and in some cases thousands of properties on what they call this buy-to-let, where they would buy a property, rent it out, buy a property, rent it out. And some of them actually got seriously burned.
That was to do with gearing.
Right, explain that.
Okay, well, a lot of people were taking the maximum amount of money you could get from a mortgage, which at the time was 90%.
Right.
There were a number of surveyors who weren't very accurate because they just wanted the business and the mortgage companies wanted to lend them money.
So they were overvaluing the properties then?
Some people have been accused of that, and there have been cases where it's been found that that's what's happened.
Right.
However, looking at the value of the properties that we've got, there's not much to undervalue. You can't go anywhere. They're rock bottom priced properties.
Right.
So there's not far for them to go. So you're not going to have the same impact. If there's a crisis and property prices go down, a lot of people went on 25-year buy-to-let mortgages and just left them for 25 years. And when they came back, they hadn't done any work, they hadn't maintained them. So you had a house that looked 25 years older.
Yes.
That hadn't necessarily been looked after with the tenants. And they were just worried about getting an income for the 25 years, weren't thinking about the future. So once their mortgage deal came to an end and they were revalued, they perhaps didn't revalue as much as they expected. But that was most houses. I've noticed that are houses that were bought in the region of £100,000 upwards.
Right.
Where again, a 20% market variation would have a greater effect on the overall value of the property.
Fascinating. So you don't see that situation really repeating itself then?
Another thing that happened was you had reluctant landlords. You had what I call not landlords that didn't want to be landlords. They were left with a property. They wanted to move. They couldn't sell in 2007 when the market crashed because their property was worth less than they paid for it or less than their mortgage. And they were forced to become buy-to-let landlords in order to move on. So they remortgaged their property, and then they were stuck in a position where they got a new house, but they've got an old house, which is quite a valuable house, rather than these smaller properties that I'm talking of. That meant that where their mortgage was maybe £600, they were only getting in £650 in the rent. So they were treading water. With a £40,000 house that we're talking about, where you're going to be making £300 a month, if there's a period when the house isn't rented, well, you're covered because you've got to put the £300 away. You've got to be sensible. You're not living on it as an income straight from day one. I always say if you can put 6 months rent away and then live on it, then you've got a number of months that it can be unoccupied before you have to feel the squeeze and start paying the £200 mortgage yourself.
So that's when I see some of the downsides of renting out property. The first is, of course, if you've got a tenant who wants to stay with you for a long time, that's great. But if you don't, if you have transient tenants, you could have periods where the property isn't rented out. Secondly, you might have a tenant who does not respect your property sufficiently and either damages it or perhaps doesn't look after it as well as they should. So that will incur additional costs for you. And then, of course, you then have the third issue, whereby someone refuses to pay you the rent but still sits in the property. So how do you sort of overcome those three problems?
Obviously, a lot of it's down to the management. A lot of it's down to the person who you're trusting to look after your property if you're not looking after it yourself, which invariably, if you're from another country, you have to have faith in the person or management company to do the job for you. Now, legally, you can get rid of tenants that don't pay their rent. There's a process that you have to go through, but it's not ideal. the best thing you can do is to obviously do your due diligence to make sure that you've got references from the tenant, take a bond. If you can get a guarantor, that's perfect, whereby they have a friend or family that actually owns a house that is security against them defaulting, if you like. And you're less
But
likely...
is that common, though? Is that common?
It's becoming more and more common in the UK, yes.
Right.
Because if your parents own a home and they won't guarantor you, what does that say about you?
Right.
If
Yes.
your own parents don't trust you to pay the rent, why should I trust you to pay the rent? So a guarantor is a good way of going around it, because who would want the risk of having a charge against a home they own because their children or friends haven't paid the rent?
Absolutely.
So there are ways you can protect it. And as for the transients who don't stay long, you normally find those in city centres where people have just come, they've just started a job, or they're students and they're not intending to stay a long time, or if they are intending to stay a long time, they want to try before they buy. They want to make sure they're happy in the city. So again, the transient market is there, but you generally get higher rent in those areas.
Ah, so that makes up for any periods that are not rented out.
Yes, and of course, Airbnb and hotels.com at the moment are in vogue, and there are reports of people making a lot of money if their house is in a strategically important place where there's lots of concerts, or a venue for sporting events, or just somewhere where there's a lack of hotels. I've got somebody who has got an Airbnb in a very unfashionable place, in the middle of nowhere, but it's busy 21 days a month because there's no hotels, there's nowhere else. So when people are visiting families or there's a wedding in the area,
they have to use his premises. Right.
and I can't believe it. Ordinarily his premises would get £500 a month.
Yes.
And he's getting £1,800 a month for the same premises.
3 times what? So sometimes it's better off to rent it out on the basis that you won't get it fulfilled every day, but you can charge 2 or 3 times
£70 a night, I think he normally gets. £70 a night. And he's got people coming there for work, because they're still working in areas, still building, there's still construction in areas. And if you've got builders coming down, they don't want to be sleeping in their vans.
Right.
They can't get accommodation on a 6-month tenancy because they might only be staying for 3 months or 2 months with the job. So they need alternatives. And with all due respect, at £70 a night, if there's 3 people in there, it is only 20 odd pounds each.
Yes.
So they're still getting...
So that's cheap accommodation for a company that perhaps rents it for their own staff or workmen.
Correct. Obviously, if there's a proliferation of Airbnbs in an area, then again, it's a supply and demand thing. But if you can identify an area where there is a lack of hotels and Airbnb, then it's a very, very good income.
Well, Brother Anthony, that's a terrific piece of advice. Maybe perhaps you'll come back again in the not too distant future, and not perhaps leave it quite so long, so that we can perhaps delve a little more deeper into property investment management as another source of revenue for our subscribers.
Certainly.
Thank you once again. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.